Think you're in total control of your spending, investing, or even voting choices? What if I told you that political psychology is quietly pulling the strings, steering everything from your grocery bill to your retirement plans, often without you noticing? In this video, I'll reveal the hidden tactics politicians use to influence the economy and your wallet, and then show you how to protect yourself from these psychological tricks. The stakes couldn't be higher. Consumer confidence can propel economic growth, while sudden shifts in market sentiment may cause billions of dollars to change hands overnight. This affects your job security, the value of your investments, and even the prices you pay for everyday items. But here's the real kicker. These dramatic moves frequently happen long before any new policy is enacted. Why? Because emotion, fear, optimism, and herd mentality tends to override logic in financial markets, and politicians know exactly how to push those buttons. Let's look at some of the psychological triggers that come into play. First is loss aversion. People hate losing money more than they love gaining it, so politicians often warn of catastrophic losses if the other side gets into power. That fear can lead to panic selling or hoarding. Next is confirmation bias. Once we have a favored position, we filter out anything that challenges it. Politicians capitalize on this by feeding us narratives that match our preconceived beliefs, intensifying market swings when one side interprets data in an overly optimistic way, and the other side predicts doomsday scenarios. Then there's anchoring. The first big number or figure thrown into a debate, like $1 trillion stimulus, can reshape our sense of a fair deal, making everything else feel too small or too large by comparison. Finally, social proof and herd mentality also play a major role. When influential figures claim everyone is selling or everyone is buying, it triggers a chain reaction, as we assume the crowd must know something we don't. If you think these ideas are purely academic, consider recent history. During the 2016 Brexit referendum, the British pound saw wild fluctuations before any actual changes to trade or immigration policies happened because both pro- and anti-Brexit campaigns made extreme predictions. Likewise, in the 2016 US election, global stock markets swung dramatically on election night alone based on fear or optimism tied to possible new leadership. And going back to the 2008 financial crisis, politicians' statements about bailouts or stimulus packages sometimes caused huge intraday market moves, reminding us how swiftly investors react to mere words. But here's the surprising twist. It's not just politicians pulling the strings. We, as consumers and investors, amplify their impact through our own emotional responses. Our fear or enthusiasm spreads faster than ever in the age of social media, where a single tweet or post can spark panic buying or selling within minutes. Polarized echo chambers reinforce our biases, making each side more convinced of impending doom or imminent prosperity. That collective sentiment is what truly drives sudden shifts in stock prices, interest rates, and even the availability of certain goods. So, how does this affect you on a personal level? It can alter your job security if companies freeze hiring due to perceived political or economic uncertainty. It can increase the cost of living if tariffs or trade tensions kick in, raising prices on imported products. It might also disrupt your long-term wealth-building plans if the stock market or housing market takes an unexpected turn after a major political speech. These aren't trivial issues. They can have real consequences for your day-to-day life. The good news is you're not powerless. Here are a few ways you can protect yourself. First, educate yourself on common biases. Just knowing about loss aversion, confirmation bias, and social proof can help you recognize them in the heat of the moment. Second, diversify your information sources. Don't rely on just one media outlet or one social network feed. Seek out different perspectives, left, right, and center, to break out of your echo chamber. Third, think long-term with your finances. Political headlines often cause short-lived market swings, so base investment decisions on fundamentals like company earnings or broader economic trends. Fourth, impose a cooling off period before making significant financial moves when bombshell political news drops. Giving yourself 24 to 48 hours helps you evaluate the situation more rationally. Lastly, maintain an emergency fund. Having 3 to 6 months of expenses saved can reduce the urge to make panic-driven financial decisions because you'll feel more secure against sudden economic swings. Ultimately, politicians understand how behavioral economics shapes our decisions. They harness fear and hope to sway public sentiment, knowing markets might react before a single law is passed. But we, the public, also play a critical part. Our collective emotions, whether panic or euphoria, feed back into the system. If we stay informed, look beyond sensational headlines, and question our own biases, we can keep our finances on a more stable path and avoid riding every wave of political drama. Thanks for watching, and I hope this gave you a clearer picture of how psychology and politics collide in the world of money. If you've ever made a financial move, like selling stocks or avoiding a purchase because of a political announcement, tell me about it in the comments. And if you found this video helpful, hit that like button and subscribe for more insights on how politics, economics, and human behavior intersect. Until next time, stay informed, stay calm, and take control of your financial future.